Want to know the single most important concept in trading? Understanding candlesticks got me from struggling and second guessing myself to complete clarity on the charts. The framework you're about to learn was for me the complete foundation to becoming profitable and getting consistent payouts. And in this video, I'm going to give you the only framework you need to master candlesticks. This video is for beginner traders, but also for experienced traders. To do this, first I will go over how to read candlesticks. Then I'm going to walk you through how to trade them and what patterns are best to use. And with this foundation, I will also give you a plug and play entry model based on only being able to read candlesticks. So let's get into it.
In the second part, we're going to talk about how to trade candlesticks. And I'll give you 4 rules as the start of the framework. And the first rule is look at candlestick patterns at important levels. And now let's dive into TradingView. That's the tool I use where I trade in to see an example of this. So right now we are at TradingView and you see here the rule, look at candlestick patterns at important levels. For example, old highs and lows. If you zoom out here, I marked a line right here at this old low, also an old low here. And I want your eyes to be drawn to this. What do you see here? So price is going lower. See this very bearish candlestick, lots of volume lower. Open, low, and then here the open, going lower again. Then we're going higher again. Price here comes to an important level, but the body is not closing below here. You see that we at an open, high, low, but the close is all the way up here. This could indicate a reversal. And you see how the candles next to that indicate we were higher prices. So we reached an important level, and then after that, we went to see higher prices. So very important there is do not look random in the chart. Look at important levels. So for example, if you would have looked for the same pattern right here. Yes, you saw like down close candles, and then we saw that massive whip up, that massive wick down, and then the body's closing up here. That indicates with a hammer that we're probably going to go higher. But you would think that, okay, this is a reversal pattern. So, okay, I see this, and then we'll go higher towards these highs, probably. But the thing is, this low was not made at an important level because there was no low here. There was no important level. There was nothing price to do. An important level is an old low, for example, right here. That's why do not look random in the charts. Look at these kind of patterns at important levels, like here, when we touch that low. Same here, we have an old high, and you see price goes into it. So open, high, low, close. We fill, the body fails to close above this high. So probably we'll see lower prices. And look how at an important level, this indicates the start of a big move downwards, all the way down here. And in the same example, if you, for example, would have looked for this exact same pattern right here, yes, you swept an old high, but it was not a significant high because it was in the middle of this whole range, this whole price action. This is a significant high because all the way up here, it's the top of the range. And then you saw this pattern, so you knew, okay, I see a green candle, but then we failed close above it. So open, high, low, close. So we're going lower. If you are looking for this at a random place in the chart, then you probably thought, okay, we'll go lower towards the lows here because this pattern wasn't there at an important level, not an old high or low. Later in this bootcamp, I will go over more important levels. For now, we're only sticking with old highs and the previous example with old lows. The second rule is look if price respects a key level. And how it looks like on the charts, look at this high. This is quite a significant high with big move down after that high. And let's see what we do. And the rule is look if price respects a key level. If we see a reversal from this high to the downside, it's respecting the key level. If it breaks it and goes higher, it disrespects the level. You can see, of course, in hindsight that this key level is not respected. Price goes through the old high, disrespecting the high. And if you see this happening, if you see that key level being disrespected, then your eyes should immediately go to where is the next important level. That was here. So you could have taken a nice long towards this high from this point where you knew, okay, we're not going to respect this level. So in this candle, you could have made your money. The third rule is the lower the time frame, the less reliable the price action. We will go over what time frames are exactly in a later video in this bootcamp. But for now, we are looking at the 5-minute time frame. That means that every candle is 5 minutes of price action. And the rule is the lower the time frame, the less reliable the price action. And a nice tip here, if you are in doubt, zoom out. And with zoom out, I mean you can go from the 5 minutes, for example, to the 1 hour time frame. At the 1 hour time frame, every candle is 1 hour. So if you look, for example, at this piece of price action right here, this is not very nice. Like it goes up, down, it doesn't go anywhere. And if you're looking for important levels and maybe some patterns, on the lower time frame, it is just simply less reliable than on the higher time frame. If we look at this exact piece of price action on the 1 hour, here at the 1 hour, it is more clear because the 5-minute time frame here, it just looked like sideways movement. But if you see here, we reach an important level that's right here. Why this is an important level, we will go over in a later episode, and then we go lower from there. And it's already indicating a reversal. Why? You see that we, in this candle, opening high, low, close. After that, we go higher, indicating possible bullish momentum because we open down here, a lower, higher, close. So we're probably going higher, but we failed to do it. We failed to close above this high. Here you see open, high, low, close, lower and lower. So on the 1 hour, you could already see that the bullish momentum, which it had in this candle at 9 a.m., didn't have so much strength because the next candle didn't continue that bullish momentum. It started a bearish momentum to the downside. So when you're in doubt, zoom out. This exact same piece price action here on a 1 hour and also on a 4 hour and a daily, you can create a more solid analysis and it's going to be more clear to you. So if you compare this 5-minute price action to this 1 hour price action, simply going to the higher time frame, so zooming out, will lead to you having a more clear bias and a more clear picture of what the market is most likely going to do. And that exact knowledge you can use in executing your trades and make money. Rule number 4 is combine candlestick patterns with other forms of technical analysis. And what you think of with this 4th rule is candlestick patterns alone are not going to do it for you. Candlestick patterns are a way to read price. But you need more for that. You need a language to speak to the market. And there are so many different languages you can speak to the market. You can use indicators, you can use support and resistance, you can use supply and demand, you can use ICT or smart money concepts. And there are so many more languages you can speak to the charts. And if you combine those different languages with your knowledge of reading candlesticks, it's going to be amazing because these languages you speak with the market, those will give those key levels to you where you should expect your candlestick patterns to form. So the rule you should remember here is that a candlestick pattern together with one of the languages you can speak to the market equals profits. What you see beginner traders do very often is they start with candlesticks because that's the most important part where you need to start. And then they search online for candlestick patterns and they see these kind of books and articles with like 50 different candlestick patterns. And what they do, they're going to memorize them all, just like in high school. Stop doing that. Just don't. You don't need to memorize every single candlestick pattern. It's not a test you need to make. Show a few you're resonating with and use that together with that language you speak to the market, like support and resistance, like supply and demand, like smart money concepts or ICT to take your entry setups. So with the rules and you not memorizing candlesticks, there's one additional thing you should do is trade with the trend. The trend is your friend. So if you see price going up, going up, going up, you should long the market. Why? The order flow, the trend is going bullish, is up. Why would you take a short, so lower, anticipating lower prices, if price clearly says to you, we want to go higher? Just try to wait for a little pullback to go long again. Same in the downtrend. The trend is your friend. So if you're on a downtrend, make sure you're not going too long. Just wait for price to come back and then boom, take that short to the downside. Trading against the trend is automatically lower probability. And for you to make money, how nice is it to just trade the most highest probability trades? That means that when you execute a trade, it's the most high probability that the chance is very high that the trade you're going to take is going to result in profit instead of a loss.
Hey, so it's finally the end of the video. And great that you made it to the end, and I hope you got some value. Click here on this video because YouTube thinks that you might be interested in seeing this one as well. And do not forget to leave a like, subscribe.